Wall Street's biggest bear has finally capitulated. Mike Wilson, the guy who told you to sell the 2022 bottom, has finally turned bullish. But could this be a contrarian signal? Because the final stage of grief is acceptance, and long-term bears are starting to accept the fact that they just might be wrong. So today, I'm going to bring you the stats and show you the probabilities and likely outcomes using nothing but the raw data. But we also need to talk about regional banks. Jerome Powell had some very choice words outwardly stating that regional banks are overexposed to CRE, and this sent the regional bank index crashing, yields soaring, and the dollar had its own rally. Risk-off assets were bought in favor of healthcare defensives. So should we be concerned? Let's talk about it. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell. Let's get into it. Another day of outperformance from technology, but specifically semiconductors. They really did outperform, and the only stocks that were green today were those like Apple, Google, that was sold quite heavily last week, stocks that are running up into earnings like Eli Lilly, like Uber, and then those stocks that outperformed on earnings like Caterpillar. Other than that, red across the board. Looking at the majors, NASDAQ, S&P 500, everything was down on the day except the US dollar. The NASDAQ was down 0.19%, the S&P 500 0.36%, the RSP nearly 0.9 percentage points down, the IWM 1.32% down, absolutely dumped. And a lot of this had to do with the fact that US fundamentals are coming in quite strong. That has spiked yields. Jerome Powell also went on a 60 Minutes interview, said a lot of things about regional banks, about the US economy, about rate cuts not coming in March. And this has had the market on its toes. Yields were flying, bonds took a dump, and the US dollar reached yearly highs. And this is going to put a lot of pressure on stocks with a lot of debt, small caps, the broader market, as well as those that derive their revenues for internationally, like the mega caps. And that's why we saw selling across the board today. Looking at breadth, it was a down day, so 416 losers, 86 winners. Extremely red day. You'd think it's an extremely red day. Looking at the sectors though, semiconductors up 2%, crazy. Technology up there as well, with some of the bigger names holding everything together. And healthcare too. Healthcare put up a good day. A lot of this was based on Eli Lilly. Other than that, from energy and the SPY downward, it was just selling in almost, but other than that, it was selling in every other sector, including regional banks, real estate, rate sensitive sectors, GDX. We do know that if yields go up, gold goes down. That's why gold miners shed on the day, as well as materials. But yeah, what we could say we're starting to see is a thin leadership at the top, but really we want to see follow through for the rest of the week. But if yields continue to do what they're doing, if the USD continues to do what it's doing, in other words, moving higher, it's going to put a lot of pressure on not just stocks, but the entire market, including mega caps, because Apple derives 45% of its revenue, the international segment. If the dollar just keeps rallying, that's going to have a tangible, 2 to 3% impact on the company. And sure, Apple can handle that, but what about these smaller cap companies that just can't afford to do that, especially with the amount of debt they have on their balance sheet? It's a very interesting times for the market. So the latest weekend poll has wrapped up. 48% of you are bullish, 52% of you are bearish, a slight edge to the bears. However, if you have been a bear in any of the last 13 weeks, only one of them you have won. The bulls have won 12 out of the last 13 weeks, but we'll see, is this week different? I'll keep you guys posted. Now, looking at some sentiment indicators, the BOFA bull bear indicator sitting at 6.1 in the middle between buy and sell zones, although an edge towards the sell zone. The Goldman Sachs sentiment indicator showing something very similar, not at stretched positioning just yet, but definitely making its way there. And this is all telling us that the sentiment is still hold whatever equities you have. It's not a sell just yet. The BOFA equity sentiment indicator is telling us very much the same, although closer towards the extreme bearishness more than it is the extreme bullishness. That being said, this indicator is also telling us it's best just to hold equities. Now, looking at breadth, this is the Goldman Sachs breadth index, currently at 25. This would be considered quite weak breadth, But what we really want to see if this continues or if we see follow through in greater breadth throughout the weeks and days ahead. If we get better breadth in the market, better than what we saw on Friday and similar to what we've seen throughout November and December, if we can see that type of breadth, that's going to be really constructive. But if breadth continues to be thin and leadership continues to be thin, that could spell problems down the road. That being said, we will keep an eye on market breadth. Now here's some trades we're currently in. This is the S&P 500 performance from Jan 27th to Feb 15th, when the previous quarter was greater than 5%, the previous quarter being October 27th to Jan 27th. We hit 18.78%, and normally when it is positive, we can expect returns of 2.3% on average. We've had 21 up years, 5 down years. The index currently from Jan 27th to Feb 15th is sitting at 1.36, so it's looking like we're going to go 22 and 5, although there's about 10 days left of this signal. If you missed the signal, however, here's one that you can look forward to next week, and it's the pre-President's Day week when the calendar year is positive. So when we've had a positive calendar year, this is where we are right now. What we can expect on pre-President's Day week, so it's the week before President's Day, and this is the Monday, Tuesday, Wednesday, Thursday, Friday. Normally the Monday, Tuesday, and Wednesday, the total returns are very, very good. 82% of the time you can get an average return of 0.7%. Since the year 2000, the return is 1.3%. So this is trades we could be looking at, and it could signal some more bullish activity before we get into OPEX here on Friday, here on Thursday, which tend to be not negative, but the hit rates tend to be pretty low and they tend to be pretty neutral. And there are some pretty negative figures, as you can see right here in this area. Now, Friday and this Thursday does actually coincide with OPEX and the 12th trading day of the month. And what do we know from February seasonal performance is that on the 11th and 12th trading day, that's when we can expect a turn to the downside in February from what is rather a pretty bullish February, all things considered. We do get a bit of weakness in the second week, which is this week, but normally the real sell side comes after the 12th trading day. This is OPEX, by the way, and this is President's Day week and beyond. So all of the stats are sort of aligning for a bullish February and then some weakness towards the end of February into March. Looking at the bigger picture, this is the S&P 500 average performance following new all-time highs. And what can we see? After we make new all-time highs in the next year, we actually get very linear returns. Sure, we do get some volatility right there and right there, but all losses are parred very, very quickly, and we do get an average return of 13.96%. 252 trading days 1 year later. Now let's talk about the big boys: Tesla, Apple, Microsoft, Amazon, Meta, Google. They all reported earnings. 6 out of the 7 Magnificent 7 names reported earnings so far. We are yet to expect Nvidia, and here's the scorecard so far. Pretty good. Everyone posting earnings growth except for Tesla, negative 40%. Amazon coming with an absolute beat. That's because they reported $0.02 of earnings. That's 2 cents earnings per share last quarter. They reported $1 today. Meta absolutely smashing expectations, 202% growth, $5.33 earnings per share. And Nvidia is yet to report. These figures are trailing 12-month figures. Now, are the Magnificent 7 overvalued, fairly valued, undervalued? According to Goldman Sachs, the Magnificent 7 is fairly valued, and here's how they calculated it. Model PE sitting just below 30, and the actual PE sitting again just below 30. That means it's fairly valued. So pretty much under this line is considered undervalued, over this line is considered overvalued, and near the line is considered fairly valued. Now, in terms of earnings, the Magnificent 7 comprise 29% of the S&P 500 and make up 22% of earnings. So its weight in the index is somewhat justified, although it is overweight because they're the only companies right now producing substantial earnings, relatively speaking. And we can see here that the consensus estimates is that the Magnificent 7 will grow sales at 4 times the rate of the 493. 12% sales growth over the next 3 years compared to 3% in the S&P 500 493. And the majority of this growth coming from Nvidia, coming from Tesla. Although I might look into this and update you guys later on in the week because of what the consensus revisions are for Tesla and the just shocker of an earnings report we got from them. That being said, 16% for Microsoft, 14% for Meta, and Apple right here still growing above the 493. Actually kind of crazy for a $2.8 trillion company. So that being said, it's really great to just have exposure to all of these companies. So buy the QQQ, guys. That's how you get concentrated exposure in a diversified portfolio. And looking at margins, at the same time Magnificent Seven are growing their earnings, they're actually expanding their margins as well. The current margin sitting on average at 20%. In 2024, we're looking at 21%, 21.7 the next year, 22.6 in 2026. And that's a 10% increase in margins based on this number right here. The 493, not quite as stellar, going from 9.6 to 10% in 2026. So still mild margin expansion, all things considered. That being said, I still think it's fair if you hold the S&P 493 with the Magnificent Seven. But that being said, it's far better to hold the Magnificent Seven versus the S&P 493, especially considering that you're getting these at a fair value price, at least according to Goldman Sachs. Now let's talk earnings. This is the latest earnings scorecard. The S&P 500 is expected to grow earnings at 1.6%. This includes earnings we are yet to expect, plus earnings that have concluded already this quarter, 1.6%, and that is actually up from the negative 1.7% and 1.4% that we had just a couple of weeks ago. And this is really what we wanted to see. We did get some terrible financial earnings, and that's why these numbers did bottom out. But it seems that we are on the up and up after the earnings week we just have. And if we can see continuation of this, maybe to the 2% mark, I think that's going to be really constructive for earnings as a whole. Now let's have a look at BOFA's earnings scorecard. Now the data I showed you previously was actually FactSet year over year. Now this is BOFA's data. Now something to note, they actually do get their data from FactSet. Now the data is a bit different. So maybe FactSet take a week to vet the data and still provide the raw data to their clients. That being said, this is what we're getting from BOFA. So what they're actually seeing is that year-over-year earnings for Q4 for the S&P 500 right now is sitting at 5.6%. This is everyone who has reported and is yet to report as well. So the S&P 500 reporting 5.6% so far. Ex financials and energy excluding that, double-digit growth, 10.2%, 5.8% excluding financials, 9.1% excluding energy. Very, very good earnings excluding these two. Then we move over to total companies beating consensus expectations on EPS and sales. Nearly half of all companies have reported, and nearly half in every sector except utilities. I think a lot of them report week after next. But what we're seeing here is that 70% of companies are beating EPS, 63% are beating sales, 48% beating both. So tons of EPS beats, and I think that's just because American companies buy back a lot of shares, but still a pretty rough go in sales, although not too bad, both numbers sitting below the 5 and 10-year averages nonetheless. And if we actually have a look at what's happening to companies after they report earnings, if you beat on both, your stock is sort of climbing in line with the average, about 2.1% after you report earnings. But if you miss on both, you're actually getting sold off well below the average. And that's because the market really likes if you beat on both, but if you miss, what the market really wants to see is good guidance. So this is BOFA's guidance ratio, and it's tracking weak at 0.5x. And this is a note they said, guidance is currently weak, but in line with a typical Jan to February. Our 1 month guidance ratio, percentage of above versus below consensus guides, is tracking at 0.5x so far this earnings season. So you beat earnings and have average guidance, you're only going up about 2%. You beat and raise, you get what Meta does, you rally 14%. You miss on both and you're going to have a very rough time. Now, let's talk about regional banks, guys. This is a comment I got on my YouTube. So leave a comment down below. I do read all of them. I'm not going to butcher this guy's name. I'm just going to call him D. D said, one thing I noticed is that CCC rated junk bond spreads shot up 0.5% on Thursday. CNN's Fear and Greed Index is also showing every indicator in greed except junk bond demand, which is in extreme fear. Something to monitor as we might be seeing round 2 of regional bank failures in the next 8 weeks. And I completely agree. Here is the junk bond demand indicator. It shot up all the way above the 1.8% mark. This was the SVB crisis, and when it started, we were sitting right here at the 1.8% mark. If we do see further continuation up to the 2.2% level where we hit the peak during the SVB bank crisis, that could really put stress on a lot of these regional banks, and we definitely could see regional bank failures. So this is something to watch in the future, and especially junk bonds versus investment grade bonds, the yield spread. And the reason why this is happening is because offices, apartments, and self-storage properties which regional banks have a ton of exposure to, have absolutely plummeted in prices, especially after the COVID situation. And having losses like this on a bank's balance sheet means they have to increase provisions, decrease profitability. We don't know what refinancing is going to look like. It just spells all sorts of troubles and leads to, well, liquidity issues, a bank run, and that leads to a bank failure. So we're definitely going to watch commercial real estate and regional banks over the next couple of weeks, and we are starting to see the signs. NYCB dropping 30% in a single day after reporting its first ever loss this past earnings season due to increased credit loss provisions. This was the Silicon Valley Bank and Signature Bank failures. You could see what happened to the entire index. Now, KRE was not that affected. They were down about 6% on the week, but this all doesn't happen in a single day or even a week. It takes a couple of months to manifest itself, and we really want to see how the Fed is going to react to it. But according to Jay Powell's most recent 60 Minutes interview, he doesn't see any stress in regional banks, but he's not going to come out and say regional banks are fucked.
What is the likelihood of another real estate-led banking crisis?
I don't think that's likely. We looked at the larger banks' balance sheets, and it appears to be a manageable problem. There's some smaller and regional banks that have concentrated exposures in these areas that are challenged.
So we're going to monitor regional banks, New York Community Bank, and a whole bunch of other banks as well to see what happens over the next 2 to 3 months. Something I wanted to add, this is the KRE, so regional banks term structure. And right now, if we look at the current term structure versus what the term structure was at the peak of the SVB crisis, we can see that the market is pricing in a bunch of nothing. Whereas when the SVB crisis happened, you can see this term structure looks like that. And essentially what this is telling us is that the market expects more uncertainty in the near term than it does in the long term. And you can see that right now it doesn't quite look like anything, although there is this slight bulge up here in regional banks. Now this can change at any moment the second puts start hitting the system, but as it stands right now, the market isn't expecting any near-term volatility in regional banks, at least not according to the options data. All subject to change. I will keep you guys updated on the regional bank term structure every single day this week. Now, on the topic of stressed assets, China's CSI 1000 index, which is China's small cap index, absolutely plummeted in last session trade. From trough to peak, it was up 6.81%, but at its low, it was down like 11% on the day. Absolutely crazy trade. And this sort of looks like that last capitulation to the downside. So maybe we should start looking at China, looking at relative strength coming into the indices, especially with stimulus checks and that sort of stuff, because there's just a lot of weakness in China stocks, so much so that sentiment is the reason why we might actually look at very long-term trades, some of the larger Chinese indices, because they were really unfazed at trade today. But yeah, capitulation in small caps in China. Now guys, let's talk about earnings. We have earnings this week. It's not a big week, but it is an important week, particularly Wednesday. We have Alibaba, PayPal, Uber, CVS Health all reporting earnings. PepsiCo, that's a very, very big name we have to watch on Friday. Caterpillar 2 for industrials. Palanta, a lot of people like the stock, and I was looking at it too. A lot to like in Palanta. And then we also have Eli Lilly. Some honorable mentions: Chipotle, Spotify, Affirm, Toyota, BP, and I think something that we could actually watch on Tuesday is Fiserv. They're a payments processor, very similar to PayPal, not quite the same as PayPal. If they produce good earnings, that might be a barometer for what PayPal might do. So let's watch Fiserv in the weeks ahead. Now, looking at Gamma, there's been some notable changes in the Gamma structure. The very first one is this right here, 48.45. The Gamma flip zone, where we go from positive Gamma to negative Gamma, has actually moved down 20 points. It was at 48.65 just last week. And I think the reason being is because this 5,000 strike is really building out. We're now touching $1.5 billion in premium at the 5,000 strike. And I do expect at some point this week, we go ahead and touch the 5,000 strike. You can actually see we're about 40 points away from that. It is going to act as very strong resistance, and do expect us to sort of test there and then bounce off. If we do go through, we might go through after an initial bounce, but to go through straight away would signify that the buying is incredibly strong. We also see a lot of Gamma building at the 5,100 strike. But that being said, with how everything's is looking, I do think we continue to buy dips, sell rips, and dealers are going to continually support price on the way down and then sell into price as we go up. That being said, this does look fairly bullish, and do expect upward price momentum to continue to the 5,000 strike, maybe to the 5,100 strike up until OPEX. Something also to note, bit of call gamma also forming right here at 4,800 and right above the negative gamma flip zone, and all of the negative gamma that was building above it here. It's actually a lot smaller relatively speaking. It probably is the same number of contracts, it just looks smaller because so much positive gamma has come in the tape over the last 24 hours. But that being said, guys, everything I'm seeing now, this looks like we buy dips, sell rips, and go all the way to 5,000, maybe 5,100, but do expect quite a lot of resistance at 5,000. And you can see here that we are officially in week 2 of February and the OPEX week next week. So what does this mean? Vanna and Charm come back in a very strong way. Dealers are gonna support price, and don't expect any major moves to the downside because dealers will be buying if price does go down. So if you are going to look for sells, it's probably going to be after expiration, after OPEX, and seasonality also points to that happening, and we spoke about that previously. Now looking at the charts, this is the monthly SPY time frame, so I just thought I'd go through this really quickly. Now this is February's candle, this is January's candle. Now something that's very interesting, we saw that is the high. January actually closed the monthly above the high, and that's the first time that happened, and that was very bullish. Right now February is significantly above that, but just saying that on the January monthly we actually closed at the all-time high above the wicks of the previous high. Now we have seen quite the early rally in the first couple of days in February, a bit of pressure coming at the top here. We're going to talk about that when you go into the daily chart. But looking at this, guys, this is super bullish, and until we actually break this area right here, the October lows, until we actually like break there, close there, and actually form a bit of price action below significantly, maybe even like turning support into resistance, until that happens, all dips are to be bought. When we do break this level right here, okay, then we could start looking at definitely lower price action and we can turn bearish. But until then, there's no reason to be bearish at all, and all dips should be bought for higher price action to go ahead and hit 5,100, 5,200, 5,300 in 2023. Now, this is also a very pivotal line in the sand because we got confluence right there, and there, as well as, you know, this area right here. So this is a very key line. But in terms of looking in the interim, we can also have a look at this right here, 4,600 on a deepest, and 4,600 is the level we want to look at on a deeper sell to go ahead and buy. But listen, this is the first level we're going to look at here, 4,600. If this breaks, then we're going to eye down targets for right here, see where that goes. But like it is right now, you look at this chart, this is a monthly chart. This is bullish because we're putting in a high, lower high, as well as making a high, higher high, and now higher high. And that's what we're seeing. At the same time, we're also breaking all-time highs in the S&P 500. And just really quickly before we continue, you're going to see this theme pretty much in every single sector. Now, what actually happened is we got sold off in very early trade, found a bottom here at the 49.20 level, and then we absolutely rallied all the way. We didn't break the highs of the day though. That's a bit concerning. That being said, there was a lot of bullish flow. All of the 0 DTE bull gang came in at these lows right here and brought us all the way up. And the same is true for pretty much every other chart. The NASDAQ, mid caps, although they gap down much weaker. Small caps, even weaker than mid caps. RSP, very similar situation. You know, stuff like energy, industrials, discretionary. But yeah, there was a lot of bullish action coming in sort of at the lows around the 11 a.m., 12 p.m. mark, where a lot of losses were parred in a lot of sectors and a lot of the indices. Now, this is the daily chart. And again, quite bullish. There's no technical damage on this chart. This is the low we want to keep an eye on if we really are going to, you know, have a substantial move lower. And in the interim, this is that 4,600 level right here. You could see this lines up with this level right here, this level right here. But let's actually zoom in on the days. So last week after the FOMC, we put out this big red candle right here. And this is where we stand. And for this week, until this level is broken and we have a close below, I would say that buy all dips, looking at higher price action. Everything about this chart, everything about the monthly, the weekly, the daily is indicative of us going longer. Earnings is coming in better than expected, not just in technology, across the board. So until we break this level right here, buy dips all the way to a higher price action, in my personal opinion. If we do get into this level, okay, we will reassess. what the market is going to do. But until, we really actually break down below here, and not just break down below, not just a close below here, all dips to be bought, looking at higher price action in the future. Look what put a lot of pressure on stocks. It was this yields. Look at the 10-year up 3.48%. Last Friday it was up another 2.4%. So yields put a lot of pressure on stocks. Looking at the Russell 2000, and now this is actually really starting to look bearish because we put a high, we put a low, then we put a lower high, and now we're sort of moving downwards. If we break this level right here, close below that level, we're probably going to go lower, use that as support, and move down in the Russell 2000s, especially if yields keep doing their thing. Looking at the RSP, a little bit stronger than the Russell because we're not quite as close to this low right here. And we actually did go wick above the highs. So we did actually go put in a higher high, and you could say this was a high, a low, higher low, higher high. And now we're kind of finding support on the daily right there to go ahead and break it, but we have to see what the rest of the week brings in terms of trade. We can't just base everything with what we saw on Monday. Maybe stocks rebound tomorrow, but constructively I've been bullish on the RSP as long as we're above the 153 level, and even more so the 155 level. So I'm looking at the sell side we're seeing in the market as just a dip to be bought until some key major levels of support are broken. Data in the week ahead, guys, nothing significant. We just have CPI revisions and initial jobless claims. We do have trade balance and mortgage applications, but a fairly light week of data. In light of that, there's a lot of Fed speakers this week. The market's going to look at this quite heavily to see if there's any change of tone. That being said, if you've made it up until here, guys, thank you so much for watching this video. Please subscribe, hit that like button and the notification bell. Like this video. Cheers.